Now, REITs have a mandated return of shareholder capital. One of the reasons I like it is REITs have to pay out 90% of their net income. Now, because it's real estate, they have a big depreciation shield, but it still ends up being, for most REITs, around 50 or 60% of their cash flow gets returned to shareholders in the form of a dividend. For most real estate, this is a great structure because the reinvestment demands are relatively lower. And so a REIT goes through the year, they pay out half the cash flow to investors, and then they reinvest the other half of cash flows into new assets, into TIs to keep tenants happy, into whatever. The problem with that structure for data centers is twofold. One, as we talked about, it's a very capital intensive space to do CapEx to keep your facility up to date. Requires a lot of cash. And then because of that mandated return of shareholder capital, you are pro-cyclically sending out the cash that you should be using to reinvest. So the more you make, the more you're sending out right at the time that you need to be reinvested in. When these data center REITs started taking re-election, I think I understand why they did it. It's because they wanted to get valued on a cash flow multiple, not on an earnings multiple. And a good way to do that is to take re-election and people stop worrying about your earnings per share and start focusing more on your funds from operations and your cash flow. And I'm wondering if in time you're going to rue the day that they took re-election for this or this. The other side of the argument for this is yes, but because they're public, they have access to corporate level unsecured debt. They have access to equity issuance via the equity market. And so if you look at a private operator, they're having to do asset-backed debt. They're having to raise private capital, whereas an Equinix or Digital Realty can do it at the market, raise $1 billion overnight from the public markets, go out to the fixed income market, raise super level unsecured debt, no problem. So they have much better access to capital and lower cost of capital than do private players at the moment. So you can't have it both ways. You can't have this sort of public markets pressure, but then you also look at the advantage of having kind of full access to capital markets.